All right, Paul Dietrich, CEO and CIO of Fairfax Gold Markets with 200 million AUM, joins us from New York City. Paul, thank you for joining us on the program, and I'm sure you join me in wishing the Dow Jones a happy 120th birthday. Not many of us get to hang around for our 120th. Paul, you seem to think that June would be a big, bad mistake for the Fed to move rates in, a bad month for them to do so. Why?
Well, you know, as the Fed is thinking of raising rates, there are some real reasons not to at this time. One of them is still the weakness of the global economy. The Brexit issue could really rile markets, although I do believe Britain will stay in the European Union. But if they didn't, it would really cause a lot of problems. We also have the inflation target was kind of a one-off deal, largely caused by the run-up of oil prices this month. And so, and then there's the most important issue of all, is that the history of the Federal Reserve is that they have never raised rates right during the middle of a presidential election. Like the Supreme Court, the Federal Reserve members, they do understand politics. And if we have the same reaction in the stock market that we had to the rate raise in December, well, it's going to be a disaster for the Democrats. It's going to be a disaster for the White House because no one wants to go into an election with the stock market tanking. And so for all of those reasons, I think they'd be much better off waiting until after the elections in December.
Paul, you know what you just told me? You just told me that the Fed is in the Democratic Party's pocket, essentially.
No, if they raise rates, they're going to hurt the Democratic Party. I don't know whose pocket they're in.
That's what I'm saying. So that's why they would withhold from doing something which is sensible. Many say, or they think is sensible. They actually think is sensible. They would withhold from what they actually want to do because of that. Isn't that being in their pocket?
Well, one, I'm not sure it's sensible. And a lot of people disagree with that. But you are right. If they decide not to raise rates until after the election, they could justify that in that the history of the Federal Reserve has been that they don't do this in the midst of a presidential election. Most people thought that their last shot was in April, and they didn't do it then, and so they shouldn't do it now. And so I think they could justify it by what has been a historical precedent with the Federal Reserve.
Okay, Paul, what's your strategy with your flagship global permanent portfolio? It's an interesting makeup here. It's quite balanced. You got a quarter of it in stock, short-term treasuries, so you got some safety valves there. Long-term bonds, gold, precious metals makes up 25%, which is actually a fairly substantial component there. And on the equity side, you've got big caps, you've got large caps, you've got the huge companies like Apple, but then you got some smaller ones as well. So it's an interesting eclectic mix.
Well, the permanent portfolio was a strategy that was developed by a professor by the name of Harry Brown back in the 60s. And he was trying at that time to figure out an investment strategy that would look like a bond portfolio, have the stability and beta of a bond portfolio, but would just never go down. And in the 41 years or so that various indexes have been tracking his strategy, they've only had one down year, and that I think was 1992 or 93, and it was just down slightly. That was a recession year. And so it's averaged, you know, 4 or 5% over that period of time every year for 41 years. And because all the assets are non-correlated. So when one asset class goes down, you'll have like gold that will go up and vice versa. And so it's very balanced, and it just goes up a little bit every month. But now that we're going
Okay.
into a rising rate environment with the Federal Reserve raising rates, that means that the bonds that people own are going to go down in value. And so we've been for the last 3 years outperforming the Barclays Bond Index, and this is going to be a key strategy for people who want a bond alternative but don't want bonds.
Okay. Paul, thank you so much for joining us, okay? Great catching up with you. You have a good rest of your day and weekend. Paul Dietrich, Fairfax Global Markets, joining us from New York.